G'day, I'm Brodie Brown. Welcome back to Millionaire Mortgage Secrets. In today's video, I'm going to address a question which I get asked all the time. It's usually an objection. People saying, oh yeah, mate, but I can afford it. And why can't I borrow that amount of money? Well, okay, cool. So today I'm gonna explain to you, hopefully in terms that you understand, how borrowing capacity is calculated, okay? So I don't want this to be a long video, so I'm just gonna dive straight in. So it's your net income. So whatever you and your partner are making, okay, if you're doing it together, but whatever you're making, whatever's coming into the household, plus any other income in the form of dividends or rental income, after tax, okay, so your net income. And then from that net income, deducting living expenses. All right, so when you're making an application, if for example, you're like, clothing, we only spend $20 a month on clothing, and then recreation entertainment, which is travel and gym memberships and having fun and going out, and it's only like $200 a month. Yeah, right, okay. And the trip to Bali costs you 10 grand. The bank has its own, banks have their own established measurement for what a typical household in a typical area earning that amount of money would spend, okay? They call it the household expenditure measure, or HEM. So even if you understate your living expenses because you know that they're gonna deduct that from your net income and you wanna borrow more, they're gonna lean back on their household expenditure measure anyway, so you can't cheat it, you can't game it. And that really happened, I forget when, maybe 7 years ago, 8 years ago, give or take, right? So you can't cheat that. So living expenses, if they're understated, the lender's calculator is going to rely on the household expenditure measure, or HEM. Deduct from that consumer credit repayments, consumer credit. So car loans, credit cards, personal loans, buy now, pay later, novated leases. So the actual repayment is deducted from the monthly income. And then there's a calculation that goes on back behind the scenes, which calculates what it's going to work out as being over the period of that loan. So if it's a 3-year loan or a 5-year loan or 8 years or whatever the case may be. So that's deducted too. Also, HECS and help debt is taken out, as is this is the bit where people get confused, okay? So the mortgage repayment. Hey Brodie, I can afford that in the real world. Why can't I borrow 600 grand or 700 grand? Here's the thing. The rate that you see, say today, 5.3%. The way that the maths are done, it's at that 5.3% plus a buffer. So the bank calculators load, typically, there are some exceptions to this, but they load 3% onto that interest rate that you see. So 5.3% is really assessed at 8.3%. You get me? So if the rate were, just to make it really simple, 5%, you're going to get assessed at 8%. All right, so we know that people were borrowing money at 2% just after COVID, and then we had a period where in the space of 9 months, I think it was in 2022, rates just ramped straight up. So now, people are actually past their and above the buffer rate. So they would have borrowed at 2, the maths would have been done at 5%, and currently the interest rates they're paying are above 5%. So the wheels haven't fallen off, the sky hasn't fallen down, everything's going okay, but you can understand the need for banks to load a buffer to assess the risk to them of your ability to repay that loan should interest rates go higher. They might do, we don't know. Now, that should be clear enough to understand. The other big determinant of how this all works together, it's almost like all of these things, and it's divided by the loan term. It's not divided by the loan term, but this plays a pivotal role in the calculation, because why? The shorter the loan term, you have fewer years to repay the loan, right? So what happens then? The repayments increase. Longer the loan term, then what? The repayments decrease. So longer loan term, lower repayments, shorter loan term, higher repayments. So a lot of people call me partly because they've read Millionaire Mortgage Secrets and they don't want to be in debt for 25 or 30 years and they want a 15-year loan or a 10-year loan. And then they wonder why we're doing our calculations and showing them information that's based around a 30-year loan term. Here's the thing, now that you understand how this is all calculated, and then you understand that there's a buffer put on the rate that you see, that whilst you would like to, in the real world, right, in practice, pay off the loan in 15 years, and you can do that, the bank won't lend you the money, because by the time you put this buffer in and HEM and everything else, you just can't afford to borrow that amount of money on that 15-year or 10-year term. So what do we have to do? We have to extend the term out to 25 years, 20 years, 30 years, whatever the case may be, whatever is required in order for you to borrow what you need. And then what we would do is we would have a strategy and a structure set up so that you are making a repayment in a certain way to equate to a loan term for you of 10 years or 15 years, or the shortest amount that you can possibly realistically achieve. But you do that after settlement. So there's two ways of looking at the loan term. The first way is what the bank is assessing you at, okay, how the bank's assessing you. So i.e., we're going to lend you this much money, $1 million over 30 years or 25 years. And then the second way is how you determine the loan term by making extra repayments or doing other things, like offsetting, for example. So I hope that's clear. I hope that's easy to understand. Please feel free to leave any comments down below. I'll try to answer them. Remember to like the video, subscribe to the channel, and I'll see you in the next one. Thanks for watching.